Tokenization is turning into the headline theme across the entire crypto space. Every week, the momentum builds. The capital involved keeps rising. And more importantly, the type of institutions entering the arena keeps getting bigger. Over the past few years, heavyweight financial institutions have stepped directly into blockchain infrastructure. This isn't a side experiment anymore. And here's the reality most people underestimate. We are still incredibly early. The large-scale migration of assets onto blockchain rails hasn't even fully started. What we're seeing now is groundwork. With that in mind, let's narrow the focus to the XRP Ledger, because what's unfolding there deserves attention. At the moment, the XRP Ledger holds close to $2 billion in tokenized assets, and that figure excludes stablecoins. Add stablecoins into the equation and you're looking at roughly another $2.5 billion layered on top. Combined, that's a meaningful footprint. But the raw dollar amount isn't even the most compelling part. What truly stands out is who is building on the network. When you examine the participants behind these assets, you find established banking institutions and serious asset managers anchoring themselves to the XRP Ledger. This isn't speculative retail flow. This is structured capital. And while tokenized stocks and bonds are impressive, they represent just a slice of the broader transformation. Stablecoins, for example, are quietly reshaping currency exchange. They enable direct on-chain swaps between currencies without relying on legacy rails. Multiple jurisdictions are already issuing or exploring digital currency formats, and adoption is spreading. At the same time, non-USD stablecoins are slowly challenging the dominance of dollar-based liquidity, which has historically controlled most blockchain settlement. Beyond currency, entire asset classes are being digitized. Firms like Control Alt are placing diamonds, property, and multiple alternative asset categories onto blockchain infrastructure simultaneously. Real estate is particularly striking. Today, only a few $100 million worth of property exists in tokenized form. Meanwhile, global real estate is valued in the hundreds of trillions. The contrast makes one thing clear. Blockchain penetration into real estate remains microscopic. The runway ahead is enormous. Recently, something notable happened in the competitive landscape of public blockchains. In total tokenized real-world asset value, the XRP Ledger moved ahead of Solana. It's not dominating the entire leaderboard, but it is steadily climbing. And when institutional adoption accelerates, trajectory matters more than headlines. Real-world assets, often referred to as RWAs, represent the bridge between crypto and traditional finance. These include tokenized funds, credit instruments, treasuries, and stable value products. When RWA activity increases on a blockchain, it signals that institutions are building real infrastructure there. The XRP Ledger has been gaining traction with institutions that prefer compliance-friendly frameworks resembling traditional financial safeguards. RLUSD's rapid expansion reinforced that signal, scaling from zero to over $1 billion in issuance within months, and continuing to expand distribution channels. Liquidity is deepening as well. Decentralized exchange activity on the XRP Ledger recently hit a multi-month high in daily transaction volume, indicating broader on-chain participation. Higher volume translates into stronger liquidity, narrower spreads, and improved capital efficiency. Technical upgrades continue to expand capabilities. New ledger primitives introduce more advanced financial structuring, improved liquidity coordination, and tooling aligned with institutional standards. Each enhancement increases throughput capacity and positions the network for continuous, around-the-clock asset movement. The broader objective is clear. Build a system where tokenized assets trade seamlessly 24/7, without dependence on market hours or delayed settlement cycles. Capital can remain active, generating yield while infrastructure operates non-stop. Now consider developments in Dubai. Control Alt, working alongside the Dubai Land Department, launched Phase 2 of a real estate tokenization initiative. After successfully tokenizing multiple properties in a pilot stage, the project moved into a controlled secondary trading phase. That means tokenized real estate can now change hands in a regulated on-chain environment, secured by Ripple custody infrastructure. Secondary markets are essential. Issuing a token is one thing. Enabling regulated resale and liquidity is another. Dubai's framework integrates tokenized title deeds into structured governance systems, aligning blockchain transfers with existing land registry procedures. This marks a meaningful step toward real-world adoption. Executives involved in the initiative emphasize that tokenization achieves full potential only when post-issuance liquidity exists. Building infrastructure that supports compliant transfer of tokenized property establishes a blueprint that other jurisdictions may follow. And this isn't happening in isolation. Across global finance, the conversation is shifting toward digital settlement as the end state. The direction of travel is toward tokenized instruments settling instantly on-chain in what's often referred to as a T0 environment. Immediate clearance and settlement. Historically, settlement cycles took 5 business days. Over time, that shrank to 2 days, then 1. Moving toward instantaneous settlement reduces counterparty risk and strengthens systemic efficiency. Regulators have acknowledged the transformative potential of tokenization in increasing transparency and predictability within financial markets. At its core, a token represents a programmable digital form of an underlying asset. Whether that asset is equity, a fund share, a deposit, or a treasury instrument, blockchain settlement allows transaction execution and finality in a single continuous process. The implications are enormous. We're approaching a financial system where nearly all value-bearing assets exist in digital form on distributed ledgers. Settlement no longer waits for banking hours. Markets don't close. Assets transfer globally in seconds. The trillions currently tokenized on-chain represent only a fraction of global markets. Tokenized equities have surpassed $1 billion, but global stock markets measure in the hundreds of trillions. Tokenized funds, commodities, private credit, and corporate bonds all show similar disparities between total market size and blockchain representation. Penetration remains minimal, but something is shifting. On the XRP Ledger specifically, asset value continues accumulating. As institutional capital mints tokens backed by tangible assets, liquidity pools deepen. Secondary markets expand. Institutional decentralized finance layers begin forming around these instruments. And here's where XRP itself enters the equation. All asset transfers on the ledger require XRP for transaction execution. As on-chain activity increases, as trillions in tokenized wealth circulate, the demand for network fuel rises. More transactions mean more XRP consumed for fees and liquidity bridging. That creates a feedback loop. Higher activity drives higher utilization, which tightens supply dynamics over time. This isn't about short-term speculation. It's about infrastructure growth. If global markets gradually migrate onto blockchain rails that operate continuously, the scale of potential on-chain value becomes massive. Not billions, but potentially tens or even hundreds of trillions over time. We are still in the early innings. The transition from traditional settlement systems to digital, tokenized infrastructure is underway, but far from complete. Every major asset category, equities, real estate, commodities, funds, credit, appears destined for blockchain integration in some form. The XRP Ledger is positioning itself as one of the networks aiming to support that transformation. And if that trajectory continues, the ecosystem built around tokenized assets could expand far beyond what most market participants currently imagine.